Now, in case of deduction in respect of one self-occupied property where the annual value is taken as nil, or the two self-occupied property from the assessment year 2020-21, the assessee will be allowed a deduction on account of interest, including 1/5 of the accumulated interest of the pre-construction period under two categories. Number one, if the loan is borrowed before 1/4/1999, then the maximum amount of interest that can be taken as deduction is rupees 30,000. If the loan is borrowed on or after 1/4/1999, the actual amount payable, and it is for the purpose of acquisition or construction, the maximum limit is rupees 2 lakhs if a certificate is also produced. But if the loan is taken even if after 1/4/99 for the purpose of repair, renewal, construction, reconstruction, etc., then the maximum amount of interest that can be claimed is rupees 30,000 only. So, the rupees 2 lakhs is the enhanced amount of deduction that can be claimed under interest on borrowed capital. If the loan is taken after 1/4/1999 and the property is, that is, the loan is taken for acquisition or construction. For the purpose of claiming deduction for rupees 2 lakhs, the assessee should furnish a certificate from the person to whom any interest is payable on the capital borrowed, specifying the amount of interest payable by the assessee for the purpose of such acquisition or construction of the property. Now, there is the ceiling of rupees 30,000 or rupees 2 lakhs. This does not apply to the let out or deemed to be let out property. That is, the ceiling prescribed for the self-occupied property is not applicable to deemed to be let out property or let out property. That in those cases there is no limit. Interest is allowable on accrual basis, not on payment basis. That is, deduction under section 24B for interest is available on accrual basis. Even if it is not paid, it can be claimed as deduction. An unpaid purchase price would also be considered as capital borrowed, and interest paid on unpaid interest is not deductible. So, these are the sum of the issues in case of interest on borrowed capital. If we see the deductions from income from house property, we can see it under two categories. One is for the let out property and that is for the self occupied property. For let out property, there are two deductions: standard deduction under section 24 subsection A, which is 30% of the net annual gross annual value, and for interest on borrowed capital, there is no limit if the house is let out or deemed to be let out. For self occupied property, we have to see if the house is purchased before 1/4/1999 or after 1/4/1999. In case a house is self occupied and the loan is taken for reconstruction, repair, renewals, etc., the maximum limit is rupees 30,000. If the house is taken for construction or acquisition, then we have to see whether the loan is taken before 1/4/1999 or after 1/4/1999. If the loan is taken before 1/4/1999, then it is 30,000. But if it is taken after 1/4/1999, in that case the loan, that is the interest, can be claimed up to rupees 2 lakhs. Now, let us see the computation of income from house property for a let out property. From our earlier discussion, if we again recapitulate the discussion, step 1, we have to compute the expected rent. Expected rent is the higher of municipal valuation and fair rent, but it is restricted to standard rent. Step 2, let us compute the actual rent received or receivable. From here, we will deduct unrealized rent, if any. Step 3 is the gross annual value, which is the higher of expected rent and actual rent received or receivable. If the actual rent received is less than the expected rent because of vacancy, then AR is the gross annual value. But if actual rent is less than expected rent because of some other reason, then expected rent will be the gross annual value. Step 3, the gross annual value is the higher of expected rent and actual rent. Step 4, we have to deduct municipal tax, then we get the net annual value. Step 6, we deduct deductions under section 24(1). So there are two deductions as we have already discussed. Standard deduction, which is 30% of the net annual value, and interest on borrowed capital. These two are deducted from net annual value, and step 7 we get the income from house property. Now self-occupied property or unoccupied property, here the annual value is taken as nil. So here only deduction under section 24(1), that is only one deduction, interest on borrowed capital is given. And as we have already told that if it is the loan is taken for repair, renewals, reconstruction, etc., the interest maximum interest is restricted to rupees 30,000. But if it is taken for construction or purchase of the house, acquisition of the house, and if the loan is taken prior to 1499, maximum is rupees 30,000. But if it is taken after 1499, in that case it is rupees 2 lakhs will be the maximum amount, but provided the construction is completed within the 5 years from the end of the financial year in which the capital was borrowed. Section 25 talks about certain inadmissible deductions, that is interest chargeable under this act which is payable outside India shall not be deducted if tax has not been paid or deducted from such interest, and there is no such person in India who may be treated as an agent. In that case, the interest cannot be taken as deduction. There is a provision for arrears of rent and unrealized rent received subsequently, section 25 subsection A. So if unrealized rent or any arrear is received, it is taxable in the year of receipt or realization. Deduction at the rate of 30% under standard deduction is allowable, and it is taxable even if the assessee is not the owner of the property in the financial year of receipt or realization. There is a confusion regarding co-owned property. Section 26 makes ample try to make it clear to the assessees that where the property is owned by 2 or more persons and whose shares are definite and ascertainable, then the income from such property cannot be taxed as income of an AOP. The share of income of each of co-owner is determined in accordance with section 22 to 25 and is included in the individual assessment. In case of flats where the house property is owned by co-owners and is self-occupied by each of the co-owners, the annual value of each of the co-owner will be nil, and each co-owner shall be entitled to a deduction of rupees 30,000 or rupees 2 lakhs as the case may be under section 24 subsection B on account of interest on borrowed capital. And where the house property owned by the co-owners is let out, and the income from such property shall be computed as if the property is owned by one owner, and thereafter the income so computed shall be apportioned among each co-owner as per the specific share. Section 27 of the Act talks about the deemed ownership. So as per section 27, the persons, though not legal owners of a property, are deemed to be the owners of for the purpose of section 22 to section 26, like transfer to a spouse, transfer to a minor child, holder of an impartible estate, member of a cooperative society, person in possession of a property, though not legal owner, and person having right in a property for a period of less than 12 years will be taken as the deemed owner. But however, in case of a person having right in a property for less than 12 years, in case of the person acquiring the rights by way of lease from month to month or for a period of not exceeding 1 year, such person will not be treated as legal owner. As we have told you that we are learning these things for accurate tax calculations as well as to save some amount of tax. Let's see, there are certain tax planning hints. Like prior to financial year 2019-20, if more than one self-occupied house property is owned by the taxpayer, only one house is considered and treated as a self-occupied property and the remaining house are to be taken to be let out. The choice of the property to choose as self-occupied is up to the taxpayer. And from the assessment year 2019-20 onwards, the benefit of considering the house as self-occupied has been extended to 2 houses. So now an assessee can claim his 2 properties as self-occupied and remaining as let out for income tax purposes. If the interest is paid out of India, tax is to be deducted. So be careful when pay interest paid out of India. Municipal taxes is paid on payment basis. So try to pay the municipal tax and claim the deduction on the year of payment. Interest payable on outstanding installments, it may be claimed as deduction under section 24 even if it is not paid.